The federal government is trying to do something very dangerous. It is trying to thread a very narrow needle. It wants to deal with the worst debt problem this country has faced in generations by creating more money and more credit, while somehow avoiding the kind of inflationary fire that usually follows when governments play this game badly. That is the plan. Whether they can actually pull it off is a different question. And if they fail, this does not stay a policy problem in Washington. It becomes a problem for every saver, every worker, every borrower, every retiree, and every investor in the country. So the first thing I want to do is strip this problem down to its bones, because once you do that, it becomes much easier to see what is likely to happen next. Right now, the United States debt to GDP ratio is around 122%. That matters because when the debt grows larger than the productive base of the economy that supports it, your menu of options gets very small very quickly. There are really only a few ways out. The first is austerity. Spend less, cut deeply, live within tighter limits. In theory, that is the clean moral answer. In practice, democracies almost never choose it in time. By the time the pain is large enough to force discipline, the political appetite for discipline is already gone. The second option is default. You simply refuse to honor the debt as promised. That option is not going to happen either, because once a country breaks confidence in its debt openly, its future borrowing power gets damaged in a way politicians cannot tolerate. So then we come to the third option: print, or more precisely, expand money and credit in whatever form is politically manageable. Most people hear that and think the story ends there. It does not, because not all money creation is the same. That is one of the central ideas in the source, and it is exactly right. Money is not simply printed and thrown into the economy like confetti. It is loaned into existence. It enters through channels, it reaches some hands before others, it changes relative prices before it changes all prices. And depending on how that process works, the result can look very different. Let me put it simply: if every dollar in existence doubled overnight, in everyone's account at exactly the same time, then prices would quickly adjust and there would be little real change in relative wealth. You might have twice the dollars on paper, but everything you wanted to buy would also cost more. It would look dramatic while changing much less than people imagine. Now take the opposite extreme. Imagine some absurd quantity of money gets created, but it never enters the actual economy. It never gets spent, never gets bid into goods or services or assets. Then there is almost no immediate effect, because the new money is isolated from real pricing. Reality sits somewhere in between. And that is where the real transfer happens. The people who get the new money first get to spend it before the full repricing occurs. They buy goods, services, assets, businesses, labor, whatever they want, at yesterday's prices or something closer to them. Then the money works its way outward. Prices begin to rise. Costs begin to rise. Asset values begin to move. And by the time the money reaches the people at the end of the line, the price system has already adjusted against them. That is why money creation is never neutral in practice. It is a transfer mechanism. And the path matters as much as the amount. That was one of the great stories of 2020 and 2021. Yes, there were stimulus checks, and ordinary people remember those because they were visible. But the bigger effect came through the channels closest to government spending, contracted flows, PPP, grants, balance, sheet support, and financial plumbing. By the time prices had risen, a lot of ordinary households had already burned through their temporary support and were left facing a more expensive world. That is how this works. Now, bring that understanding back to the current problem. The source argues that the government is trying to solve the debt problem with money printing again, but it is trying to do it in a more selective, more growth-oriented way than before. Not simply spray money and pray, instead stimulate productive activity through the financial system while hoping to avoid an outright inflationary blowout. That is the theory, and there is historical precedent for why they might believe this can work. After World War II, the United States had a debt burden that was also enormous relative to the economy. The government used a mix of financial repression, engineered low rates, and monetary expansion to help work through it. But there was one enormous difference. Then spending collapsed. The war ended. Factories stopped making things only for destruction. Resources got redirected into civilian production. Men came home and returned to productive life. The economy shifted from wartime distortion back toward private output. That mattered, because it meant the same monetary and credit environment that helped carry the debt was also being accompanied by a large increase in real production. Today, the source says we do not have that release valve. Federal spending is still enormous relative to GDP. We are not coming off a one-time war spike that naturally unwinds. We are living inside a long, grinding structure of entitlements, debt service, and obligations that do not fall off a cliff once the emergency ends. Social Security is not disappearing. Medicare is not shrinking because somebody gave a speech about fiscal restraint. The liabilities are rising, not falling. That is why the current setup is more dangerous. The country is back at debt levels reminiscent of wartime extremes, but it got here through persistent structural spending, not through a temporary national mobilization that can simply reverse. That is a very different trap, and it leads directly to what the source says is the next move. Bank deregulation specifically, the easing or removal of the supplementary leverage ratio. Now, you do not need to memorize the regulatory jargon to understand what matters here. The basic point is that banks have balance, sheet constraints that affect how much they can buy in treasuries and how much they can lend elsewhere. If those constraints are loosened, two things can happen at once. Banks can buy more government debt, and banks can free up more capacity to lend into the private economy. That is the needle the government wants to thread. It wants a larger bid for treasuries so the government can finance itself more easily and push interest costs lower. It also wants more lending into private business, corporate refinancing, investment hiring, and productive expansion so that the economy grows fast enough to carry more debt without collapsing under it. That is the whole dream: more credit, lower pressure, more growth. Less visible inflation than last time. The source reminds us that they tried a version of this before in 2020, when the leverage rule was temporarily suspended and bank lending accelerated quickly. That environment felt wild because money and credit were flowing everywhere. The mistake then was not merely that credit expanded. The mistake was that enormous money printing from the Fed came on top of it in a way that supercharged the inflationary effect. This time, the source says, the hope is different. The hope is that if banks, rather than the government directly, are the main transmission channel, then profit incentives and credit discipline will direct more of that new money into actually productive uses rather than pure waste. That is a reasonable hope. It is not the same thing as a guarantee, and that is where the source lays out the two broad scenarios we are really facing. In the first scenario, banks buy more treasuries. Yes, but they also lend aggressively and intelligently into the productive private economy. Businesses refinance. Capital gets cheaper. Investment picks up. Hiring improves. Production expands. GDP grows. The pie gets larger. There is still inflation risk because more money and credit are moving through the system. But the increase in real output absorbs some of the pressure. That is the good version, not perfect, but workable. In the second scenario, the banks take the easy path. They use their freed up balance sheets mostly to buy treasuries, support financial engineering, backstop markets, help private equity, help leverage, help asset inflation, but they do not direct enough of that expanded lending toward broad productive growth. In that version, the people closest to the new money benefit first. Again, financial assets rise. The politically connected and already capitalized do well. The broad real economy does not get the same lift, and ordinary people get stuck paying higher prices into a system that feels richer on paper and more unequal in practice. That is the bad version. Not because asset prices fall, because they may rise. The source is very clear about this, and I think it is one of the most important points in the whole document. If the government chooses money creation over austerity or default, then broad asset prices are more likely to go up than down. That is the central lesson people keep missing. They think sovereign debt stress automatically means market collapse. Sometimes it does if governments choose discipline or forced default. But if governments respond the way they usually do, with more credit, more easing, more support, and more monetary cushioning, then what often rises first are the assets owned by the people closest to the money. That is why the source says you need to be an asset owner, not as a slogan. As a survival principle, if the country is going to lean on monetary expansion and credit engineering to deal with an impossible debt burden, then sitting in cash and hoping morality wins is not a strategy. It is an invitation to get diluted slowly. Asset owners have a chance to move with the new money. Cash holders absorb the loss in purchasing power. That is the blunt truth. Now let me say something carefully here because this matters. The source calls this money printing. But it also emphasizes that the path of the money matters more than the label. That is exactly right. If the credit creation runs through banks and actually finances real output, then the inflation may be less savage than last time. If it mostly props up government deficits and asset inflation without increasing production enough, then the same old transfer happens again. The top benefits first, the bottom pays later. So the real question is not whether more money and credit are coming. The real question is where they go first, and this is where portfolios begin to matter. If you think the most likely path is either of the source S2 scenarios, then the logic becomes fairly straightforward. Long-duration cash is vulnerable because the purchasing power problem does not go away. Debt-heavy governments do not magically choose hard money discipline after they already crossed the line. Traditional savers get quietly punished. First, asset owners have a better chance. And it is not only stocks in the abstract, it is ownership in productive businesses, ownership in assets with pricing power, ownership in scarce things, ownership in structures that can ride liquidity rather than drown beneath it. That is what the source means when it says, position yourself as close to the money printer as possible. That phrase sounds provocative, but the mechanism is actually plain. If newly created credit is going to enter through Treasury demand, bank lending, and financial intermediation, then assets sitting near those channels are the first beneficiaries. The person waiting for fairness is not. Now, I do not think this means you blindly chase everything. It does not mean you throw discipline away and buy every speculative object with a ticker. It means you stop pretending that the old debate between safe cash and risky assets still looks the same in a debt crisis. It does not. When the debt load is this large and the political system refuses austerity and rejects default, the remaining path almost always points towards some version of dilution, sometimes faster, sometimes slower, sometimes more visible, sometimes hidden behind technical policy language and bank regulation changes. But the result is similar. The system protects itself by leaning on holders of nominal claims. That is why the source keeps hammering on one simple point. Things are only going to get worse from a debt perspective. Entitlements grow, liabilities grow, the interest burden grows, the path of least resistance remains more debt and more credit creation. That means the burden falls on people who are not positioned to ride that cycle. So let me bring this to the simplest possible conclusion. The government is trying to pull off a difficult trick. It wants to print and lend enough to keep the debt system functioning. It wants to do it through banks and deregulation rather than only direct central bank firepower. It wants growth to absorb the debt and offset the inflationary consequence. Maybe it works partially. Maybe it fails partially. But in both versions, the same basic lesson survives. If you are far from the new money, you are likely paying for it. If you are close to productive assets that can absorb and reflect that new money, you have a chance to come out ahead. That is not how the system should work in some moral sense, but it is how the system does work. And if you already know that, then the only intelligent response is to build accordingly, not tomorrow before the next wave starts.